Wealth transfer. Baby boomers are anticipated to pass along more than $68 trillion in what's being called the Great Wealth Transfer. So having a plan is crucial in order to have a smooth transfer of wealth. Wealth transfer has two primary methods. The first is gifting during one's lifetime. The second is an inheritance at one's passing. Communication is at the core of a successful plan. Providing insight to loved ones that you have a plan, that they'll be involved in the plan is key. You do not necessarily have to provide detailed information about the plan, but sharing of high-level information, like the structure of the plan, the method and/or timing of how an inheritance should be expected, is all good practice. Also, loved ones that are going to play a specific role or duty, such as a trustee or power of attorney, should be notified. Generally speaking, it's important to have documents such as a will and/or trust outlining your wishes. Wills and trusts can be drafted by an estate attorney, and the cost will vary depending on the complexity of one's estate and their wishes. It's a good rule of thumb to revisit and review such documents every 3 to 5 years, or when any life-changing event occurs. Also, don't forget to include non-financial assets. Investment accounts, bank accounts, and real estate are typically the focus. However, non-monetary items need to be considered as well. Highly detailed accounting of one's possessions and one's wishes to inherit them can lead to less confusion among loved ones. Now let's cover a few of the most common wealth transfer strategies. The annual gift tax exclusion. For 2024, the IRS allows individuals to make gifts of up to $18,000 per year to an unlimited number of individuals with no federal or state tax consequences. A spouse can give the same amount, doubling the amount a couple can gift. For example, a husband and wife with 2 children could give away a total of $72,000 a year to them, $36,000 to each child without any tax repercussions. And those gifts that are made, money is removed from their taxable estate. Irrevocable life insurance trusts, or ILITs. These are often viewed as attractive because the proceeds are inherited, estate, and income tax free. The value of the death benefit is not considered part of the estate. Be aware, these are irrevocable, meaning once the policy is in the trust, it cannot be moved out of the trust. The grantor retained annuity trust, also known as a GRAT. This can be advantageous when you have an asset you expect to appreciate over time, don't have a federal exemption left, or you're not comfortable transitioning a large asset just yet. What can be valuable about the GRAT is any appreciation in the asset from the day it's placed into the trust to the day the GRAT is terminated is estate tax-free. However, if one passes away during the predetermined term of the trust, then all the assets in the trust will be included in the taxable estate. Deciding on the best way to transfer your wealth can be complex, and there are a lot of moving parts to consider. If you would like help determining what options to consider, please take advantage of our free financial assessment.